Ever wonder how some entrepreneurs sell their companies and walk away with $0 in federal taxes? It's not magic, it's QSBS. And today we're breaking it all down with someone who knows the space inside and out. Meet Alessandro Chesser, founder of Get Dynasty, a tax strategy firm helping high growth founders and investors turn opportunity into generational wealth. We're talking loopholes, legislative updates from the big, beautiful bill, and more. Buckle up because this is the tax hack every startup founder needs to hear. So, Alessandro, welcome to the show.
Thanks for having me, Mike.
So just to kind of get started, there might be a lot of business owners or maybe founders or people that are going to be future founders that are listening to this and maybe have never heard of QSBS. So give us a general lay of the land. What is it? Who does it apply to? And kind of where can it be beneficial?
Yeah, so QSBS, we call it the greatest tax exemption that exists. It stands for Qualified Small Business Stock. It's applicable to basically any startup founders or early employees or executives or investors. So anybody who holds shares in a qualified small business, that's what they call qualified small business. In order to qualify, you have to acquire the shares in the small business before the company has, and the rules have just changed on this. So the rule for most companies that already exist, you have to acquire the shares before the company has $50 million on its balance sheet. Primarily, the company has to be a technology business, not a services business, and you have to hold the stock for at least 5 years. There's a couple other qualification criteria, but as long as you qualify, then you can get up to $10 million in tax-free capital gains. And again, that's going backwards for companies. With the new bill signed, the rules have changed a little bit, and I know we're going to get into that. So mainly what I'll be referring to now is for most companies that already exist, it's up to $10 million in tax-free capital gains. Depending on the state that you live in, your state may also recognize QSBS. So not only would you get that on the federal side, but you may also potentially get it on the state side as well.
That makes sense. So when you're looking at a business owner that or an initial employee of an organization, of a startup organization that has some stock options in it, give me the basic understanding of what needs to be done in order to qualify. So you kind of mentioned if you're a service-based business, so those law firms out there organizing a C Corp, this wouldn't apply to them, right? So most of the time we're looking at a software type company, but it doesn't necessarily have to be a software company. It just can't be a service-based. So could it be like a manufacturing type company that would qualify for this?
Yeah, so there's basically, it's not about who qualifies, it's about who doesn't qualify. There's very specific criteria for companies that don't qualify. Tend to be like banks don't qualify, law firms don't qualify, any of these like highly regulated, traditionally service businesses don't qualify. Like really what they're trying to do here, the regulators, is trying to spur like technology and like innovation. And so primarily this is like startup company, technology based venture capital funded startup companies. Those are the main companies that are going to benefit here. And the specific companies that don't qualify are more of your old school manufacturing companies. Absolutely can qualify as long as they're not, your traditional manufacturing company, but your manufacturing company that's using technology to create more efficiencies. Like that's the type of businesses that want to be able to benefit from this. And I would say for any businesses that don't know whether they're qualified or not qualified, there are specific accounting firms and law firms and service providers like my old employer, Carta, who will actually do an analysis for you, looking at your company, looking at your balance sheet, and looking at the specific rules behind QSBS to see if you qualify for QSBS or not. I highly recommend that for anybody who sits in any of these gray area industries. But for most companies who are, utilizing technology, may or may not be venture capital funded, but are a startup company, have less than $50 million on the balance sheet, those are going to be companies that fit right in the sweet spot. And so you want to, again, you have to hold the stock for at least 5 years before you sell. But if you do that, then you qualify for the tax exemption.
Yeah, no, that's great. And so, I think a lot of people might be hearing this and like, okay, this is great. I'm looking to sell my business in the next 3, 5, 10 years from now. And they're wondering, but they've never heard of this before then, or they've heard of it, but they've never kind of thought it was applicable to them. Let's say they go find out that it is applicable to them, but they have been running as, say, an LLC, or they've been running as an S corporation for the last 5 years, 10 years, 15 years, and they have an exit point of maybe 10 years down the road. Is there any opportunity for them, since they were not originally organized as a C Corp, is there opportunity that they can still take advantage of this strategy?
So absolutely, we actually started as an LLC and we flipped into a C Corp when we did our first round of venture capital financing. I mean, you actually can get even more benefits if you do it that way, because when you flip to a C Corp, especially when you're doing a priced venture capital round like we did, the pre-money valuation that we use, so we have a pre-money and post-money valuation. Pre-money for us was $14 million. So the way the rule exists is it's either $10 million in tax-free capital gains, or it's 10 times your contributed value. And so for us, that pre-money valuation, when you flip from an LLC to a C Corp, whatever the LLC was worth becomes the contributed value. So for us in this example, it was $14 million. 14 times 10 is 140. You subtract the original pre-money valuation. So 140 subtract 14 ends up being $126 million worth of qualified small business stock eligibility we got. So the original shareholders, we divided up among the ownership group, 3 owners, $126 million worth of QSBS eligibility. We ended up with, 42 million, $42 million worth of QSBS eligibility each because of the way that we did it. Because if you flip from an LLC to a C Corp, you get that advantage. So I think that anybody that's an LLC or an S Corp that thinks that they could potentially benefit from this, there's definitely a trade-off, because there are advantages to operating as an LLC and S Corp from a tax perspective, right? I'm sure you can speak to that as well. But you have to determine, are you going to be selling this company? If so, do you want to get it to qualify for QSBS? Is that QSBS, up to $10 million worth of tax-free gains or whatever else you get on top of that based on the contributed value? Is that going to be more beneficial to do it that way versus getting the tax benefits of operating as an LLC or an S Corp today? And so there is going to be a trade-off, but I think for people that are looking to sell their business, and now the clock does restart though. The 5-year clock, the second you flip to a C Corp, it starts from zero. So, but since the rules have changed now, you no longer have to hold the stock for 5 years. You can hold the stock for 3 years and you can get a 50% exclusion, or you can hold it for 4 years and get a 75% exclusion. And if you do end up holding it for 5+ years, you get the 100% exclusion. But you can benefit from not holding it as long now and getting a partial exclusion, at the 3-year mark. So I think anybody who's looking to sell their company, they should absolutely be considering this, and they should talk to a good CPA and determine whether or not it makes sense based on their business and where it is today.
Yeah, that's a great point that you bring up, because we have conversations all the time with small business owners that are, they see a TikTok video about how every business should be organized as a C Corp because you can take advantage of this opportunity, but they don't have, a well-established business. They don't have a good valuation yet, and they probably won't look to sell this thing for 20 years down the road. And so it's good to know that there's that opportunity that they can organize as an LLC or organize as an S corporation, operate like that, and get the tax benefits from that standpoint. And then when the time makes sense, or when they get closer to that exit point, then they can go to look at an exit, transitioning to a C Corp, qualifying it, and then have that potential tax-free exit from it.
That's right. And the important thing is, if you're going to do that, give yourself at least 5 years, or at least 3 years, but really 5 years if you want the 100% exclusion. And because the rules have changed now, that's another thing that I know we're going to get into later. But because the rules have changed, not only is the timeline adjusted where you can hold the shares for 3 years now and get a partial exclusion, but also the actual exclusion has changed. It's no longer up to $10 million in tax-free capital gains. Now, for new companies going forward, you can get up to $15 million in tax-free capital gains. And then if you do it as an LLC or S Corp and you flip it to a C Corp, you get 10 times the contributed value. So you can really stack up the gains here And people that set this up correctly could exclude most of the taxes that they would otherwise end up paying.
Yeah, that makes sense. And so we'll talk about some of the changes from the One Big Beautiful Bill and how that impacted, because there's definitely an enhancement of this offering. But before we dig into that, I just want to get, just from a personal opinion, if you were a business, let's say you've been operating for 20 years as an S corporation, and you're looking at saying, okay, within the next 5 years, we're planning to sell this thing. Maybe it's 10 years. We're planning to sell this thing. What would be the reason, if you're a qualifying business, what would be the reason that you could think of that you would not want to transition your business to a C corp for this purposes? Is there any downfalls from outside of some of the tax benefits of an S corp versus C corp and the double taxation, those things? If we take that out of it, is there any reason that you would say a qualifying business would not take advantage of that opportunity to transition?
No, I think the tax benefits are the main reason why you'd want to stay as an LLC or a C corp or an S corp. It's taking advantage of the no double taxation. Like, of course, that's the number one reason why. But aside from that, if the gains from the sale of the company and the tax exclusion are going to be significantly more than the benefits you're getting from a tax standpoint, then there's no other reason. No, you would flip. It's easy to operate a C corp. I would say, from my perspective, when we were as an LLC and then we became a C corp, to be honest with you, it was actually more complicated to operate as an LLC because we couldn't, there were rules on how we couldn't really hire employees directly. They had to be like 1099. We couldn't offer them benefits. It was more complex to operate that way than after the fact we flipped. And, we fit right into all the HR platforms very nicely. And so, I think that's also maybe more of the type of business we are. We're more of like a venture funded startup company. So it makes a lot more sense to be a C corp. But, from that perspective, I mean, the tax benefits are the number one reason not to do it. If you're operating as an LLC or S corp intentionally because you're a profitable business, if you're not looking to sell your business, that's the number one thing. If you're not looking to sell your business or go public, then keep it operating the way that it is. But if you are, then you really need to do that analysis to determine what's more beneficial, the tax benefits you're getting today or the tax benefits you could be getting in the future.
Yeah, that makes complete sense. So let's talk about the changes a little bit. Obviously, we had a big bill that passed from a tax standpoint, and this made the QSBS made its way into that bill. And so talk to us a little bit about what changes the One Big Beautiful Bill put into place that impacted QSBS.
So 3 specific things. The exclusion was $10 million. Now it's up to $15 million. And this is going forward for any stock that is issued after July 4th. Stock issued prior to July 4th of this year, 2025, is going to be subject to the old rules. So the old rules exclusion is 10 million. The new rules, it's 15 million. And that's significant. You can just add up the tax, think of an individual living in the state of New York. And like I said, some states recognize QSBS, some states don't. There's really only 5 states that are not going to be able to take advantage of QSBS, and also have like state income taxes. That's California, New Jersey, Alabama, Mississippi, and Pennsylvania. So if you live in any other state other than those 5, you're going to get full QSBS exclusion. So if you think about that, for an individual who lives in New York specifically, because New York is very high state taxes, especially if you're in Manhattan, there's really large city taxes as well. I think combined state income plus city, Manhattan, you're looking at close to like 15% in taxes. And then the federal capital gains tax rate, 20 plus 3%, 23%. So in New York, literally you're looking at about 40% of your gains that will go to taxes. But with QSBS, you can exclude up to $15 million completely tax-free. So, you're saving $6 million in taxes roughly. By qualifying for QSBS in the state of New York, if you sell your company, you're going to save $6 million in taxes. And if you do qualify for QSBS, you're going to get the full $15 million. You're not going to pay any taxes at all. So it's significant, especially in a state like New York.
Yeah. And so talk to us as well, because there was some time period that we briefly talked about, but it's the 5-year hold that we talked about, that you get the full 15 million exclusion. But there was some changes in I think it was a 3-year hold, 4-year hold, something
Yeah.
like that. So talk to us a little bit about those changes that came through that can be beneficial as well.
Yeah. So the two other changes, duration you're referring to, the holding period. Before you had to hold the stock for 5 years to get 100% exclusion. For 5 years, you get up to $10 million in tax free capital gains. Now they've changed it so that you can be eligible if you hold the stock for 3 years instead of 5. So if you hold it for 3 years, but you don't get the 100% exclusion, you'll get a 50% exclusion. If you hold it for 4 years, you'll get 75%. And then 5 years or greater, you get 100% exclusion. So this is super helpful for people that sell their company quick. Because before, you start a company or you flip from LLC to C Corp, you have to hold it for 5 years. Now you just have to hold it for 3 years and you can get 50% exclusion. So it's huge. It's a big, big difference. The other thing that has changed is the asset limit. So before, you had to acquire the shares, and if you're a founder, obviously you acquire them before the company has any money on the balance sheet. But this wouldn't work for a C corp that's flipping to, or a LLC that's flipping to C corp. If you already have substantial assets on your balance sheet, then you may look into this and see that it's not worth it because you may not qualify. So before, the rule was 50 million in gross assets. Now you have to acquire the shares before the company has 75 million gross assets. So it's 50% increase. So a lot more businesses and employees are going to qualify now. So they just made it easier. They've made it easier and to get a larger benefit. And it's already, as I consider, the greatest tax exemption that exists, and it's only gotten better. So, I mean, the whole idea behind this is to, to stimulate small businesses, to make it easier for small businesses to raise capital from investors, because there's more advantages now, more tax advantages for the investors as well, and to stimulate innovation and to create more startup companies, and to really make the United States a competitive place and a place where more investors want to invest and more, highly talented individuals want to relocate to and start businesses.
Yeah, it's crazy. We talk about the tax code all the time, and I think a lot of times small business owners are afraid of tax planning because they feel like they're cheating the government. Like, oh, I moved my tax bill from $100,000 bill to a $20,000 bill. I feel like I just cheated the government from that. But all we're doing is we're utilizing code that the government wants us to use, but they don't tell us how to do it. They don't do it for us. It's our requirement to learn it and put it into place, but it's there for a reason. And you kind of just iterated that point. A lot of people would look at this and be like, why would they put this in the tax code? And it's there for a reason. It's an incentive for people to start businesses, to have startups. And so same thing as when you get bonus depreciation on real estate, the incentive is the government wants people to build real estate. And so how do they do that? They incentivize from a tax standpoint, because we don't want the government doing our startups. We don't want the government building our housing. And so the government says, we don't want to do that either, but we're going to encourage our citizens to do it in the form of a tax incentive. And so it's just taking advantage of that. Now, Alessandro, talk to us a little bit about if somebody is looking to go down this route, they want to learn more. You talked about some law firms, accounting firms out there that kind of focus on helping you if you qualify. Talk to us a little bit about what you guys do at Get Dynasty, and then also talk to us like kind of what would that process look like? Hey, I'm a startup, or I've been around for 10 years looking to sell my business. I think I qualify. What does that process start to look like as we start to go down that road of saying, oh yeah, I'm going to utilize this tax strategy?
Yeah, so two questions there. Number one, what does our business do? We help people create trust to get more QSBS eligibility. So if you're already a C corp, you haven't, if you're an LLC, then you have the ability to expand it above the 10 or $15 million already. But if you're already a C corp, you're going to be locked in, especially if it's a company that's already existed for a few years. You're locked in at the $10 million exclusion. Now, the rule is $10 million per taxpayer. So you can set up trusts for family members, for your children, for your parents, for your siblings, whoever, future children. And each of these trusts will get its own $10 million tax exclusion, QSBS exclusion. So you create 4 trusts, you get $40 million worth of potential tax-free capital gains. And so we help founders do this. We have a full stack solution. We help with trust creation. We help with trust administration. We're a licensed Nevada trust company, so we serve as the Nevada trustee. We help file the annual tax returns for these trusts, and we do it for less than 5% of the normal cost, working with a normal trust company or normal lawyer. It's because we've utilized technology to automate the process, and because we're 100% focused on it too. We're not a law firm that's trying to support all these different type of individuals, and we help people with real estate. We just help people with one thing. We just help startup founders stack QSBS trusts. So we help them get more QSBS eligibility. And so the key part here is that even though you're creating trusts, you're giving shares away. That's an important thing to know. You're not, stacking it for yourself. You're stacking it for family members. But because you're setting up these trusts versus gifting shares directly to your family members, you can control the trust. So if you decide that the trust after you sell your company needs to invest in real estate, you can make that decision. If you want the trust to invest in your next startup company, you can make that decision. So by keeping it in the trust, you've retained a level of control over the assets. Even though you don't own them, you can have a sense of control. So that's exactly what we do. We help founders do that. We just launched the product a couple months ago. We're already at 40 plus founders who've signed up for it and are taking advantage of it. And then as far as your next question, what should a founder do if they're thinking about this? I think step one, if you're interested, you can talk to us. You can go directly to getdynasty.com and we can help you navigate it. If you know that you're already qualified, we can help you set up trust. If you're not sure if you're qualified, there's a number of providers out there that we have in our network that we can connect you with that will do a full analysis on your company. And they can help you determine if you're qualified. And Mike, do you do that? You may do help with qualification. I'm not sure.
Not from a specialty standpoint, no.
Yep.
Yeah, sometimes we'll talk to founders and help to guide them down that route, but from a complete, sign off on it, typically we refer them to an attorney that specializes in it.
Yeah, you need like a QSBS attestation letter. And so we have partners that can help you with that. My former employer is probably one of the biggest ones now. I used to work for a company called Carta. Carta is the system of record for startup companies and startup investors, and they have a big QSBS attestation business. And so they'll do an analysis. They'll make sure you're qualified. Once you find out you're qualified, then we can determine if you want to create trust, how many trusts you should create, and that's really what we go through the process. If you're a later stage company and there's already significant value, definitely want to work with the CPA and figure out, how much of your lifetime exemption you want to use. Because when you gift shares to a trust, you're cutting into your lifetime exemption. You can only gift up to this year $14 million in your lifetime without having to pay any transfer taxes. So do you want to use the entire 14 million? Do you want to use part of that? Do you want to preserve it for later in case you start your next company? And that's where we rope in your, the CPA that you work with, or the planner that you work with to determine like exactly what should be gifted, how many trusts you should create and how many shares should go in them.
Makes sense. So when you start the trust, is that starting that 5-year window again, or are you already tacking on to the original?
It rolls into it. So it just grandfathers in whatever, if you already held the stock for 5 years, you can create the trust and literally, you shouldn't do it this way, but you can literally, go public or sell your company 6 months later and take advantage of it. Now just, we tell people you want to do this as early as possible because otherwise you're going to raise red flags with the IRS. And also it's going to chew up more of your lifetime exemption. So the best time to do it is as early as possible when the shares are worth nothing because you can gift them out of your name and you can preserve your entire lifetime allowance.
Makes sense. And so when you talk about this, QSBS, no tax on the gain, like it's always really sexy, right? And you see people on TikTok that put 60-second videos and all these different things out there. And then people start to just kind of rush into this concept without truly knowing anything about it, without truly knowing if they even qualify. So just from your experience on working with companies, with founders and being a founder yourself, what are some of the most common mistakes that you're seeing people make when they're trying to think about or take advantage of QSBS?
Yeah, I think the most common mistake is, not thinking about it until it's too late. And like, oh, I'm raising a big venture capital round of financing next week. I'm going to get a term sheet. Oh, no. What do I need to do now? Now they call us and we're like, you're not going to be able to get this done by next week. You should have done this like months ago or years ago. So I think that's the biggest mistake is like people just drag their feet and they don't think about it until it's too late. And that's, you need to do it when it, when you don't do it, when you don't have anything going on at all. Like that's the most,
Hmm.
that's when you do it. Cause when you do have stuff going on, it's going to be a fire drill. You may not be able to get it done. You may not be able to take advantage of it. Like that's mistake number one. Other than that, I think that, I think that's the biggest thing is people don't plan for it early. You have to plan for it early.
Yeah. Would you say, on that same note, would you say that a potential, and obviously you work on the QSBS side, but from my standpoint, I think sometimes too is people do it too soon. So they are a brand new company, don't really even have a product out there, but they're planning for this exit that might happen. They don't have investors. So they're planning for something that might never happen, and they might operate as a very successful company for 20, 30 years before they ever even look at an exit. And I think sometimes I see business owners that say, I'm just going to start up as a C Corp because I know I'm going to take advantage of QSBS. And now they're jumping into something that they might not even get the benefit that QSBS offers because they never sell, or they never get to a point where a sale is even a viable option to them. So it's almost like that balancing act of, okay, let's make sure that we have something legitimate here. Let's start a proven record, but then also have at least some type of strategy for what does that exit look like? Is that exit a 5-year? Is that exit a 30-year? Are my kids just getting it on the exit? Having that type of plan can then help you decide, okay, when does it make sense to start to go down that QSBS route?
Yeah, I think the first question is, are you going to build a bootstrap profitable business or are you going to go raise outside capital? If you're going to raise outside capital, that you're going to be, that's venture capital. That's the whole purpose of the industry is to fuel growth. You wouldn't take any profits at all. You're putting everything back into the company to fuel growth. So in that case, there's no advantages to operating as an LLC or an S corp. You might as well just throw it back into the company as a C corp. But if you're going to be building a, bootstrap cash flow positive business, yeah, like LLC S corp is going to make a lot more sense. And so then you need to ask yourself, the second question is, okay, am I going to be selling this company within the next 5 years? And if not, then you just start as an LLC, build your bootstrap profitable business. And as you start thinking about an exit, that's when you need to start thinking about flipping to a C corp.
Yeah. With, again, the same concept of being, don't be too late.
Yeah.
Don't have that LOI on the table and then reach out to Get Dynasty and say, hey, I'm looking to take advantage of QSBS and we're a month from close. Probably not going to be a great fit.
Don't be too early and don't be too late.
Yeah. Well, this has been great, Alessandro. I really thank you. This has been super helpful. Again, there's so much misinformation out there. And so I think it's helpful to break down, okay, when does this make sense? What are some of the situations that you're seeing? And, just to end it on your side, is there any kind of success story that you've really seen that this has really played out with? Tell the audience a little bit about what you've seen on your being front lines on this.
Yeah, so two different situations. The reason why I found out about this is because my old CEO, he did it. He created 4 trusts and sold $40 million worth of tax-free capital gains. And like, he told me about it. When he told me, that's when I was like, wait a second, why doesn't everybody do this? I looked into it. I'm like, oh, it costs a couple $100,000 to set it up. Like, of course, everybody can't do this, right? And that's why we were like, we should make it available for anyone. And so we productized it, and you can set up 4 trusts with us for $1,000 a year, like super cheap. And if in 3 years from now your company goes out of business, that's your fixed cost, $3,000, like $1,000 a year. It's a small fixed cost, but it's enormous potential upside. The other example is a very public one. It's written about, in major journals, and it's the CEO of Roblox, the gaming company. He created 12 trusts you can't do this late. You got to do it in the very beginning because you can't get that much out of your name, without triggering gift tax issues. So you do it in the very beginning when the shares are worth nothing. You get the shares out of your name. He created these 12 trusts. He took the company public. He got $120 million worth of tax-free capital gains. And so, the intention there, like I said from the beginning, is that he's going to take that money and he's going to fuel the ecosystem, and he's going to reinvest into startups, and he's going to start his next company, and it's just going to drive innovation. But $120 million worth of tax-free capital gains, like, where else can you get that? Like, does that exist anywhere else? This is the greatest tax exemption that exists, and you have the ability to take advantage of it by creating trust and setting up trust funds for family members and friends. And it makes a ton of sense. Like, maximize it. People that have kids, even easier. If you don't have kids, gift to your parents. And, those trusts can be reassigned to your future children when you have them. And so there's a lot of flexibility, especially if you utilize trust structures and create that exist in a state like Nevada. Even though the trust is irrevocable, there is a lot of flexibility that actually comes with those type of trusts. So, look it up, like the CEO of Roblox, 12 trusts. Like it's a great example. And, we help to make that possible for any startup founder, any small business founder who this would make sense for.
Yeah, that's amazing. So, if you thought tax law was boring, Alessandro just proved otherwise. So whether you're dreaming of a future exit or advising clients who are, QSBS could really be the single most important strategy that you aren't using or aren't thinking about. So huge thanks to Alessandro from Get Dynasty. Make sure to check them out at getdynasty.com. And don't forget, planning early can be the difference between paying millions or paying nothing. Now, if you found this helpful, don't forget to subscribe, hit that like button, share it with a business owner who's sick of paying too much in tax. And if you want help from our team of tax pros implementing this strategy, along with so many other tax strategies, visit taxelm.com. That's TAXELM.com, or click the link in the description for a free discovery call. We're helping people just like you legally lower your tax bill every single day. Thanks for coming on, and see you on the next one.
Thanks for having me.